Every indicator you're using is a lagging measurement of what already happened. And the more indicators you add to your chart, the worse your trading gets. Nobody wants to hear this because we spent weeks learning these things. We watched hours of YouTube videos explaining MACD crossovers and RSI divergences and Fibonacci retracements. We convinced ourselves that if we just found the right combination, the right settings, we'd crack the code. Here's the truth that destroys that fantasy. Indicators don't predict anything. They don't tell you what's going to happen. They tell you what already happened, dressed up in colorful lines that make you feel like you're doing something sophisticated. And that feeling, that illusion of control, costs traders more money than almost anything else. Let's talk about why your chart looks like a Christmas tree and why that's the exact reason you're not making money. You start trading, and the first thing everyone tells you is learn the indicators. RSI for overbought and oversold. MACD for momentum and crossovers. Moving averages for trend direction. Bollinger Bands for volatility. Stochastic for. Honestly, I'm not even sure anymore. The list never ends. So you start adding them to your chart, one by one. RSI goes on first. Then you hear MACD is better, so that goes on too. Then, someone says you need moving averages to confirm the trend. So, now you've got the 50 period and the 200 period cluttering up your price action. Then you discover Bollinger Bands, because some guru said they're essential. Your chart is packed now. There's barely room to see the actual candles. And here's what happens. RSI says oversold. MACD says momentum is bearish. The 50 moving average just crossed below the 200. Bollinger Bands are squeezing. What do? You freeze. Or worse, you cherry pick whichever indicator supports what you already want to do. You wanted to go long anyway, because you've got a feeling about this stock. So you focus on the RSI being oversold and ignore everything else. You're not trading a system anymore. You're justifying your emotional decisions with math. And the worst part, you think you're being disciplined. You think you're being analytical. You're doing technical analysis. Except you're not. You're doing technical justification. Here's what actually happens when price moves. Let's say a stock breaks out. It rips higher. Volume explodes. It's clearly bullish. Buyers are in control. Momentum is building. This is obvious just from watching the candles and volume. But your indicators, they don't see it yet. Your moving averages are still pointing down because they're averaging the last 50 or 200 candles. Your MACD hasn't crossed over yet because it's waiting for the shorter moving average to cross the longer one. Your RSI is climbing, but it was lagging behind the actual price move. By the time all your indicators line up and give you the green light, the move is half over. Maybe more. You finally get your confirmation and you enter. Then the stock pulls back. It's just a normal healthy pullback after a strong move. But your indicators, now they're all screaming overbought. So you panic and exit. You just bought high and sold low because you waited for lagging indicators to tell you what was already obvious, and then you let those same lagging indicators scare you out of a winning trade. I knew this guy, Daniel, who had 7 indicators on his chart. 7. He spent 6 months perfecting his system, backtested it on years of data, had a whole spreadsheet with his rules. RSI had to be above 50. MACD had to be cross-bullish. Price had to be above the 200-day moving average. Volume had to be above the 50-day average. Bollinger Bands had to be expanding. ADX had to be above 25 to confirm trend strength. Stochastic had to be in agreement with RSI. When all 7 lined up, he took the trade. Guess how often all 7 lined up? Almost never. He was sitting in cash 90% of the time waiting for perfect confirmation. And when everything did finally line up, the move was usually exhausted. He'd enter right as the momentum was fading. Took him 8 months to figure out his system was just an elaborate way to avoid trading. He was so afraid of being wrong that he built a system that required the entire market to confirm his bias before he'd take action. By the time he got that confirmation, there was nothing left to capture. He finally blew up the whole system, wiped his chart clean, started trading with just price action and volume. Within 3 months, he was more profitable than he'd been in the previous year. Not because he found some secret strategy, because he stopped waiting for permission from lagging indicators and started responding to what the market was actually doing in real time. Here's the thing about professional traders, the ones managing serious money. Go watch interviews with them. Go read their books. They're not talking about indicator settings. They're not debating whether 12269 or 8179 is better for MACD. They're talking about price action, order flow, supply and demand, market structure, support and resistance, volume, the actual mechanics of how markets move. Paul Tudor Jones doesn't have 14 indicators on his charts. Neither does Steve Cohen. Neither does any trader who's consistently profitable over decades. They're watching where buyers and sellers are actually showing up, where the big money is getting involved, where supply overwhelms demand and price drops, where demand absorbs supply and price rallies. That information is right there in the price and volume. You don't need a mathematical formula to show you what's already visible. Think about what an indicator actually is. Take RSI. It's just a mathematical calculation of recent price changes. It's measuring momentum by comparing the magnitude of recent gains to recent losses. That's it. It's not magic. It's not predictive. It's just math applied to historical data. When RSI hits 70 and everyone says it's overbought, what does that actually mean? It means price has been going up more than it's been going down recently. Okay, but strong trends stay overbought for extended periods. Tesla in 2020, RSI was overbought for months while it just kept ripping higher. Bitcoin, in 2017, overbought for weeks at a time during its run to 20K. If you sold every time RSI hit 70, you missed the entire move. The indicator told you it was overbought. The price told you buyers were in control and momentum was accelerating. Which one was right? And here's what really exposes the absurdity. Different time frames give you completely different signals. RSI might be oversold on the 5-minute chart, neutral on the 1-hour chart, and overbought on the daily chart. Same stock, same moment in time, 3 different signals. So, which one do you follow? The answer: whichever one confirms what you already wanted to do. You're not following a system, you're shopping for confirmation bias. Let me tell you about March 2020 again, but from a different angle. When COVID hit and markets imploded, every single indicator on every single chart was screaming sell. RSI was oversold beyond anything we'd seen in years. Moving averages were cross-bearish. MACD was plunging. Bollinger Bands were stretched to extremes. If you were trading based on indicators, you were either already out or getting stopped out. The indicators were unanimous. This is bearish. Stay out. Stay safe. Meanwhile, if you were watching actual price action, something interesting started happening in late March. The selling was slowing down. Volume on down days was decreasing. When price tried to go lower, buyers started showing up, small at first, then bigger. The candles were telling a story. The bloodletting was ending. Smart money was starting to accumulate. This wasn't obvious from RSI. This wasn't in your MACD. This was in the actual behavior of price and volume. The traders who bought in late March and April, while every indicator said, don't do it, they made fortunes. The traders who waited for their indicators to turn bullish, they bought in May or June or later after the market had already ripped 30 or 40% off the lows. Same information available to everyone. Different interpretation, different results. Here's the psychological trap with indicators, and this is important. They make you feel safe. They make you feel like you're being scientific and systematic. You're not just guessing. You've got indicators. You've got confirmation. This removes the responsibility from you. When a trade goes wrong and you had 5 indicators confirming it, you don't feel as bad. You did everything right. The indicators were wrong. Except the indicators can't be wrong because they're just calculations. They're not making predictions. You were wrong for thinking a mathematical formula could tell you what thousands of market participants are about to do next. The indicator didn't fail you. Your reliance on it did. And this is why traders keep adding more indicators. This one didn't work, so maybe I need another one. Maybe I need to combine 3 indicators. Maybe I need to tweak the settings. It never ends. Because you're trying to solve a human behavior problem with a math problem. Markets move because of human decisions, fear, and greed. Supply and demand. Not because an indicator crossed a threshold. I watched this happen in real time on Twitter during the 2021 meme stock craze. GameStop is going vertical. It's up 400% in a week. Every indicator on the planet is beyond overbought. I'm talking RSI at 95. MACD in another universe. Bollinger Bands so stretched they're not even on the screen anymore. And there are hundreds of traders posting their charts saying this is so overbought. It has to crash. I'm shorting this. I'm buying puts. The indicators say it's over. They got destroyed. Absolutely obliterated. Because the indicators were measuring past price movement, not the social momentum and short squeeze that was actually driving the price. The price was telling you there's an unprecedented amount of buying pressure. The volume was confirming it. The story was obvious if you were paying attention to what was actually happening instead of what a lagging calculation said should be happening. Indicators don't account for context. They don't know there's a short squeeze happening. They don't know retail traders just discovered options. They just calculate numbers and pretend that's analysis. Here's what changed everything for me. And I'm telling you this because it might save you years. I was struggling, had indicators everywhere, thought I was being thorough. Then, I read a book by Al Brooks about price action trading, and he said something that broke my brain. If you took away all your indicators and just watched price and volume, would you still take the same trades? I realized the answer was no. I was taking trades because indicators said to, not because price action made sense. So, I did an experiment. Wiped my chart completely clean. Just candlesticks and volume. That's it. For 2 weeks I didn't trade. I just watched. Watched how price moved. Watched where it found support. Watched where sellers showed up. Watched how volume changed at different price levels. And something clicked. The market was speaking a language I'd been ignoring. When I started trading again, just price and volume, my win rate went up. My confidence went up. My stress went down. Because I wasn't waiting for 5 different calculations to align. I was responding to what was actually happening. Price makes a higher high and higher low. That's bullish structure. Price finds support at a previous resistance level. That's confirmation the level matters. Volume dries up on a pullback. That's a healthy consolidation. This isn't complicated. This is just paying attention. But I couldn't see it when my chart looked like a rainbow, threw up on it. Here's my challenge to you. And I know you won't do it, but I'm going to say it anyway. For 1 week, trade with a clean chart, just price and volume. Watch what actually happens when price moves. Watch where it hesitates. Watch where it accelerates. You'll see opportunities you were missing. You'll avoid traps you were falling into. Because you'll be trading what is instead of waiting for confirmation of what already was. And that's the entire difference between traders who make it and traders who blow up blaming the market.